Chapter. We're talking real money.
I was talking with a friend the other day, and the talking about getting old, and the big downside we both agreed to getting old was how fast time moves. Holy cow! A week just feels like a couple of days, and so therefore it feels just like a couple of days ago that it was Friday, and I was doing this again, taking your questions that you sent in to our website, talkingrealmoney.com, which I enjoy doing a great deal. And we're going to do it again right now because this is the Friday Q&A day. And thank you guys a lot. We're getting a lot of questions, which is really great because it's going to enable me to record some stuff ahead, take some vacation this summer while I'm on the road, traveling cross country in my Airstream, visiting with some of you around the country. And thank you for the notes. I'm going to start answering them as soon as we firmed up everything. We are going to be meeting some people in Madison. We're trying to find a place to actually have a barbecue with folks in Madison because Tom's going to be there too on Saturday, the 20th of July. We're trying to find a place near where we're going to record the show, which is at Lunny Lake Park. And I looked and I couldn't book the pavilion, so I'm going to have to call the county parks department. Anyway, go to talkingrealmoney.com and check out the trip. And, of course, record your questions there. Questions like this one.
Hey, Tom and Don. You guys were talking about ETFs being superior to mutual funds. I just had a few questions. I've looked quite a bit online. I've checked the Bogleheads forums about how to purchase ETFs and how to do proper trading. And it looks like you kind of want to limit market orders just because of any kind of craziness that might happen. But then a limit order you put in, and it's like if you put it in for the exact ask price or the bid price, it's like it moves away quite a bit. So I was looking at Bogleheads, and they were talking about doing a marketable limit order, which is a few cents. Like say you're buying like a few cents above the ask price if you're buying something like BTI. That way you avoid any kind of craziness with a flash crash or something. But at the same time, you pretty much just get a market order. So I was wanting to see if you might be able to go over, maybe in a podcast, over like how to purchase ETFs, what's the best time to do it, just maybe some best practices as far as ETF purchases. If you have any questions, feel free to reach back out to me. Thank you.
If you're ever going to find a bunch of good-hearted people who are prone to overthink things, it's in online forums of any kind, not just Bogleheads, but online forums. I read into this on the Airstream forums that I visit about tow vehicles, and there's just a lot of overthinking. We get down into the minutia, and for most of us, we don't need to live in the minutia. The minutia is called minutia because it's minute. It's tiny. The differences in ETF bid and ask spreads is, for the most part, incredibly small. It's negligible. It's minute. So you don't really need to worry about placing market limit orders, doing any of that to try to get a slightly better price because the prices are pretty good, bid or ask. There have been some studies done that have shown that midday tends to be better because there isn't a lot of last-minute trading or, getting in the first thing in the morning after a whole night trading. But the differences, again, are going to be small in the grand scheme of things. Yeah, a little bit of money makes a difference here and there, but we're talking about tiny, teeny, tiny, like hundredths of 1% overall, particularly in the index ETFs, the big index ETFs, the non-traded ETFs, because they have a pretty substantial float, a lot of players in those ETFs. I would really not worry about it. We're not going to get into ETF timing and trading strategies ever, even when it comes down to just trying to time it in, to get the best execution, because there's just too much activity. There are too many people, and it's not going to help much. In fact, I don't see it helping at all. You could end up not buying at certain times. Just buy when you have the money to buy, because over the long run, when you buy doesn't really matter that much. The biggest factor is that you buy when you have the money to do so. You want to be in more than you want to be out, and don't overthink it. Please don't overthink it. Your questions, send them. TalkingRealMoney.com is the place to do that. You just click the contact form, and then you can speak your question, or you can type your question, because we do those on other podcasts and our regular shows. But we do the recorded ones generally on Fridays. Now, let's do the next one.
Hello, Don. A while ago, you did an episode on fees and how they can drastically change how much you end up with in retirement. Something like 3% fees equals 700,000, 2% equals 1.4, and 1% fees equal, something like 2.2 million. So my question is, you guys recommend AVGE, or you talk about it a lot. And that fund has an expense ratio of 0.25%. Is that the total fee? Because if I look at the holdings, it also holds AVUS, which has a 0.15. So do each of the individual holdings inside of AVGE account for the 0.25 fee? Or is it 0.25 plus whatever percent I have in AVUS at another 0.15 and so on down the path? So basically, are they compounded? Thanks for your input. Have a great day.
Thanks for the call. Absolutely. Fees impact returns. However, we're down here in these ETFs in the very low end of the fee pool. There aren't a lot of differences, so don't worry too much about your fees. As for AVGE, that's a fund of funds. Funds of funds quote an expense ratio that is the total expense ratio for the funds they own in the portfolio. It's not an expense ratio on top of an expense ratio. So what you're seeing is what the total cost of all the funds added together, divided by the number of shares, that's what your fee is going to be. So that 0.25, that's total fees charged. And again, that's a very low number. Can you get a lower number? Yeah, but the nice thing about AVGE is that you're paying up a little bit to get a more expensive portfolio to purchase and to manage, to run, to own, because you're getting into smaller companies and more value-oriented companies. So don't worry about it. You're in great shape. Now, let's take another question that came in from TalkingRealMoney.com.
Hey, Don. Hey, Tom. This is Brian from Sacramento, and I am so thankful for y'all just to start for, the whole changing the world thing. So 2 things today. I am a relatively new investor. My specs are, I'm about 3 years into investing. I'm about 40, going on 41 in a few months. So I got started late. I'm diligent. I do about 30% of my income every year. I try to invest. 2024 is different. I am, as Jill Schlesinger says, doing a reset. So for that reason, I haven't really invested much in 2024. And that has to do with my question. I'm a little uncomfortable with that. Deep down, I know it's okay. Because A, I'm doing a career reset and I'm putting more money into my business this year, which is the number 1 investment. Number 2, I'm always behind the 8 ball on tax season. I'm always one of those guys that files an extension and I always pay my taxes in September 14th at 11:59 p.m. So I kind of wanted to change that, not that it really matters that much, might even be better to put money into my portfolio before paying Uncle Sam compounding wise, but peaceful wise, I want to feel better about this tax thing and try to pay quarterly. So I'm catching up and I'm trying to pay early tax this year. And number 3, I am, let's see. So the business, the taxes. I'm trying to increase my emergency fund. I've only ever had about 2.5 months at most of an emergency fund. I'm trying to at least double that to 5 months. So for all of these reasons, I am pulling back this year on investing. And I hope it helps someone else out there in my same position. But I'm looking for some feedback, man. I know you and Don, or at least I think I've heard you and Tom, say that you have both at some point had to pull back, maybe there's a job loss at some point or a family member needed help and you couldn't invest for a period. Please talk a little bit about that and help me feel some comfort, because I kind of feel like I'm dropping the ball here. I know I'll get back to it probably by the end of this year. So part of me wants to not invest all of 2024 and focus on those goals. Part of me wants to meet myself in the middle, as opposed to doing 30% of my income, maybe try to at least max out a Roth this year or something, set a different goal. So please talk a little bit about that, because I feel a little uncomfortable. Also, this is another note entirely. I know you said a couple of Saturdays ago that you don't like guests or interviews, Dawn. I don't really like them either, but I did like when Larry Swedrow was on, and I think maybe you guys were toying with the idea of having him on again. I'm always a fan. But also, I just saw Stan the Annuity Man with Paul. I know how you guys feel about annuities. I'm very similar. I don't really subscribe to them or the idea of them even. But I know a lot of people do, and he seems to be a pretty stand-up guy in the whole world of annuities, big air quotes. It'll be kind of fun and entertaining and maybe even educational for some to hear you guys, Don and Tom, go head-to-head with the Stan, the Annuity Man, about annuities. Just a little listener suggestion, might be a little bit edutaining for us. All right. Thanks you guys so much. I'm going to stop this long recording. Cheers.
Thanks for listening. Started late? 40 is not getting started late. 55, 60, that's getting started late. You're great. And you're putting away, up until this year, you were putting away 30% of your income? Dude, you're in great shape. You can afford to take a year. Good news is, and this is not a market timing thing, but here's the silver lining to doing it right now. This has been a really good year for stocks, and it's best to buy during really bad years, particularly when you're younger and you've got a 20-plus year accumulation phase. So, yeah, you just accidentally picked a great time to not be buying a lot. And I think what you're doing is smart. Tom and I, you mentioned it, Tom and I have done this multiple times in our lives, because the greatest wealth is always made through our efforts. The world's billionaires didn't get to be the world's billionaires by buying stocks, for the most part. Even the hedge fund managers kind of through gaming things a little. But it's not through just investing in the stock market. That's not going to get you rich. That's likely to make you money because it has in the past. But if you want to really build a nest egg, you build a business. And Tom and I both did that multiple times. Failing sometimes, succeeding to some degree in others, succeeding very well in one particular case. Kind of the last one we did. So do that. You're getting your life together. Yeah, it's smart. It's smart. The reset is a great idea because it's a good idea in your case. I do agree. You need to get that emergency fund up. It is not as critical at your age because you have the ability to change direction relatively quickly and start earning more money if needed, probably. And adjusting lifestyle is another one that is relatively easy to do if you don't have expenses that can't be adjusted, like expensive health care. So, is there anything else? Oh, your suggestion. Yeah, I'd kind of like to have Stan the Annuity Man on. I generally, we get inundated with guest requests, but it's almost always somebody who's pitching something. Well, it's 99.9% of the time somebody who's pitching something, has a book, has a warped perspective, trying to sell. In fact, sometimes it's people trying to sell Ponzi schemes. We actually had that, except we exposed it, which is what we do, and then we make guests mad. I guess that's not a bad idea, is it? It makes for a good podcast. Anyway, thank you. Thanks for listening. Thanks for being a loyal listener, and I really, really, truly appreciate all your questions. I hope I got through all of them. I think I did. Yeah, you're good. All right. Remember, TalkingRealMoney.com is the place to go with your questions. TalkingRealMoney.com. Click the contact form. Okay? and then you'll see a mic. Record your question. Just like this one.
Hi, Tom and Don. I love your show. This is Roxanne calling from Central Texas. I'm 69 and I want to set aside $100,000 in my traditional IRA earmarked for my great nieces and nephews. I'd like to know a good total world ETF or mutual fund to stash it in for about 20 years. My family has long life genes. Thanks so much for what you do.
Thank you very much for the comments. I appreciate them. We both do. Thanks for listening. This is very nice. This is awesome. You're going to save for the kids long term. That's terrific. It's money you're not. You're sure it's money you're not going to need. As long as you're sure it's money you're not going to need. And for the kind of time frame you're talking about, well, an earlier question gave you one of my favorite answers, and that is the Avantis All Equity ETF. It is aggressive. It has tremendous potential, I believe. It is invested in basically the entire world market with a few exceptions, but they overweight the two biggest factors that have been shown through academic research to add return over time. And those are small company stocks and value stocks, high value stocks. It also has an international component, which we think is critical for those times when the U.S. market does tank by itself. It's done it. So I think AVGE is an absolutely wonderful choice, well-diversified, low fees, easy to buy through any brokerage account anywhere, easy to sell through any brokerage account anywhere, and a terrific way, I think, to build wealth for those kids. Thank you so much for doing that and being a member of our audience, and please spread the word. Tell others. Now, it's time for our last one for the day. 5, that's a good day. TalkingRealMoney.com. Go there. I forgot to mention. Saturday. See, if you listen to this on the day we put it online, that's a Friday. The very next day is Saturday. On Saturday, almost every single Saturday, except when Tom is in Africa and I'll be here alone, we're together here, and then sometimes alone here, taking your questions. And that's our favorite part of what we do, is talking to you live. And we can talk live every Saturday from 3 p.m. to 5 p.m. Eastern Time, noon to 2 Pacific, at 855-935-TALK, T-A-L-K, or 8255. 855-935-TALK. Every Saturday, 3 p.m. to 5 p.m. Eastern Time. Just call, and you'll join us on our radio show. Okay? Now our last one for the day.
Hi, Tom and Don. I'm currently 51 years old. I have a state pension from a previous employer. I can start drawing it at 55, or I can wait until I'm 65. If I draw it at 55, I can get a $353 a month benefit with a 100% joint survivor benefit. If I draw it at 65, my benefit is $532 a month for joint survivor. I'm thinking of drawing it at 55 and putting the money in my Roth IRA until I retire. We're currently saving very well for our retirement. What are your thoughts?
Every time we have this question, it comes out right about a wash, the difference. And that makes sense because the annuities, the pensions, have done the math. And you're going to end up pretty much the same position no matter what you do. The real difference comes down to taking risk. If you're willing to take risk, you have a chance of coming out ahead, doing what you think you want to do. That is taking that 353 and investing it over the next decade. How would that work out? Well, this is what's interesting. If you invest that at about 8%, you get about 8%, which is a stock bond portfolio historically in the past, you would end up with about $65,000. $65,000 plus your $352 ongoing would get you to about $550 a month. Pretty darn close to the $532 you would have gotten if you just waited to take the annuity at 65, the pension. The difference is the $65,000. That's now money you own. It belongs to you. You can do anything you want with it. But to get it required taking risk, because if over 10 years it didn't make any money, then you're going to have a fraction. You're going to end up with less. That's how it works out. If the market doesn't behave, you're going to end up with a smaller amount to live on. If the market does well, you're going to end up with about the same to live on plus $65,000. If the market does great, you'll end up with more. But that's the risk component is what enters into almost every one of these decisions, because behind the scenes, the math has been done. They're not going to give you any added bonus for waiting 10 years. It's just that the money's been sitting there. It continues to grow. They'll pay you more. So it really depends on you, your risk profile. And that's really what almost all of these questions come down to. It's either a risk question or it's an emotional question. But there are rarely any ways to beat the system, because the system can do math really well. Thank you all so much for your questions, your calls, for listening, for being a part of this, for really being so flippin' loyal. We just love it. Thank you, all of you. And if you get a chance, please tell other folks. And call us on Saturdays, every Saturday, 3 to 5 Eastern, 855-935-TALK, 855-935-8255. Well, I think that's it for today. Oh, and by the way, go to TalkingRealMoney.com for all kinds of other things. If you want to meet with one of our advisors, you can do that for free. Literally free. You're not going to get a high-pressure sales pitch. We don't do that. We've been doing this for years. Have you ever heard anyone say, "Oh, those guys at Appella, they're really high pressure"? No, we don't do that. We're just trying to help. Do we make a living doing it? Heck yeah. Should we? Well, we can't do it for free. We're not getting rich, but we are here all the time because you need it. Talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.